Hi everyone. There is a portfolio that most investors have never considered building. It holds 200 companies, it collects dividends from every major economy on earth, it has survived recessions, crashes, and market panics without breaking, and it costs just $14 a year on every $10,000 you invest. It is built from two funds most people in this community already know, but almost nobody has put them together correctly or understood what they actually create when combined. That is what this video is about. Hey, welcome back. This is SCHD, where we turn big financial ideas into simple steps anyone can act on. Nothing here is financial advice. Always consult a licensed professional before making any investment decisions. Let's get into it. The danger of owning only one country. From January 2000 to December 2009, the S&P 500 delivered a negative return of minus 0.95% per year. Not a bad quarter, not a rough year, an entire decade where the most famous stock index in the world went backwards. Investors who held only U.S. stocks had to wait until early 2013 before they were back to even in real terms. 13 years watching their accounts go nowhere while life kept getting more expensive around them. Here is what most investors never learned from that decade. Those who owned international dividend-paying stocks alongside their U.S. holdings did significantly better. International value and dividend stocks outperformed the S&P 500 throughout most of that stretch. One group was protected, the other was punished. The only difference was owning both sides of the globe instead of one. The pattern is well documented. U.S. stocks dominate for a period. International stocks dominate for a period. Back and forth. The investor who owns both never gets destroyed by being on the wrong side of that cycle at the wrong time. Right now, the S&P 500 trades at roughly 25 to 27 times earnings. The fund that holds the 100 best dividend payers outside America trades at approximately 14.7 times earnings. You are paying nearly twice as much for every dollar of U.S. earnings, and that gap has never stayed open forever in the history of global markets. What you actually build. SCHD holds the 100 best dividend-paying companies in America. Every holding has paid dividends for at least 10 consecutive years. Every holding passes 4 strict financial screens: cash flow strength, return on equity, dividend yield, and dividend growth. The weakest companies are removed every March and replaced by stronger ones automatically. SCHY does the exact same thing, outside America. The identical 4 screens, the identical 10-year payment history retirement, applied to the best dividend payers in Japan, the United Kingdom, Germany, Switzerland, Australia, and other developed markets around the world. When you own both, here is what you actually hold. 200 companies, 0 overlap, not a single company appears in both funds. Every major economy represented, every holding screened and proven. Built and maintained by Charles Schwab at a combined cost of $14 a year per $10,000 invested. No stock picker, no fund manager taking 1% of your money every year. Just an automatic system selecting the best dividend payers on earth and paying you every quarter to own them. The number that makes this combination special. The correlation between SCHD and SCHY is 0.67. In plain English, these two funds do not always move together. When one rises, the other does not always follow. When one falls, the other does not always drop with it. They move in the same direction, about 2/3 of the time. That remaining third is where your protection lives. Compare that to SCHD and the S&P 500, which carry a correlation of 0.83. If you own SCHD and a broad U.S. index fund, you're heavily exposed to the same economic forces hitting both at once. Adding SCHY genuinely breaks that connection. Income from different economies, different currencies, and different business cycles all working at different times. Here is the number that surprises most people. SCHY's maximum drawdown since launch is 24%. SCHD's maximum drawdown over its full history is 33%. The international fund has actually fallen less during the worst market periods than the fund most investors consider the safe choice. Most people assume international means more risk. The data says the opposite. The hidden bonus most investors never use. Here is a strategy built into this combination that almost nobody is teaching. Because SCHD and SCHY move differently, your portfolio will drift over time. SCHY might grow to 55% while SCHD drops to 45%, or the reverse. When this happens and you rebalance, bringing both back to your target split, you're automatically selling what just went up and buying what just came down. This is not bookkeeping. This is a mechanical, emotion-free process that generates real additional returns. Studies show that rebalancing a low correlation portfolio like this one can add 0.5% to 1% in annual returns above simply holding both funds and never touching them. Not because you did anything clever, because the system forces you to buy low and sell high on a schedule, without feelings getting in the way. This is the same discipline behind SCHD's nearly 13% annualized return since 2011. The machine removes emotion. Emotion is what destroys most investors. 4 forces working for this portfolio. These are not options. They are structural shifts confirmed by data. The first force is the valuation gap. SCHD's holdings trade at roughly 18 to 19 times earnings. SCHY's holdings trade at approximately 14.7 times. You own quality on both sides, but the international side is significantly cheaper. When cheap quality catches up to fairly priced quality, the price gain arrives on top of the income already being paid. The second force is the dollar. The US dollar fell nearly 10% in 2025, its worst annual drop in nearly a decade. A falling dollar is an invisible pay rise for SCHY investors. When a German company pays a dividend in euros and you convert to dollars, a weaker dollar gives you more dollars per euro, without the company doing anything differently. Every SCHY dividend payment quietly benefits from this shift. The third force is global shareholder reform. Japan's stock exchange has required companies to pay higher dividends and buy back more shares. Japanese shareholder payouts have grown roughly 4 times over the past decade. Across Europe, companies in Germany, the UK, and the broader continent are sending more cash to shareholders than at any point in recent history. SCHY holds companies sitting directly in the middle of all of it. The fourth force is income from 2 directions simultaneously. SCHD currently yields approximately 3.4%. SCHY currently yields approximately 4.1%. Combined, this portfolio generates blended income near 3.8%, paid every quarter, while SCHD's 10-year dividend growth rate sits at nearly 11% annually. You're not just collecting income today. You are building income that grows year after year from 2 separate economies. Warren Buffett has committed to holding his Japanese dividend positions for decades and stated he expects his successors to hold them long after him. He's not chasing performance. He's locking in undervalued, growing income for generations. That is exactly what combining SCHD and SCHY does for investors who will never have his billions. Here's the question you need to answer honestly. If the US stock market delivered another lost decade starting tomorrow, 10 years of going nowhere like the 2000s, would your income keep growing? Would your retirement stay on track? Or would you be watching 13 years pass without moving forward? 200 companies, every major economy, a combined cost of $14 a year per $10,000, 0 overlap, a correlation low enough to provide genuine protection, and a rebalancing bonus that grows your wealth automatically. 2 funds, built on the same rules, covering the entire world, costing almost nothing to own. This video is for educational purposes only and is not financial advice. Always do your own research before investing. If this changed how you think about your portfolio, hit the like button and subscribe. Drop your answer below. If the US entered another lost decade tomorrow, would your portfolio survive it? That debate belongs in the comments. I'll see you in the next video. Smart investing, profitable results.